Path Trading Partners, Bob Iaccino, joins us now. He is in Chicago. Bob, good to have you with us again.
Good to be here as always, Michael.
You're not concerned that this might just be a weather-related blip? Usually the retailers blame this kind of data on that sort of thing.
Whatever the weather is, right? We had warm weather being blamed for winter apparel not selling. We had cold weather a couple years back being blamed for things not flying off the shelf because people were out enjoying, the cold weather thing, people weren't going out. And it's one of the reasons we've talked in the past why I like Amazon, because I think that takes sort of weather effects out of retail. But getting back to the point, I'm worried about retail in general because of the overall looks of things. You talked earlier about the personal spending numbers, the PCE, and note the big revisions to January specifically and February as well. And if spending is being compressed like this, I'm worried about the retailers. I'm worried about the overall market completely, but I'm worried about the retailers specifically.
And from what I understand, you're also worried about one of Canada's most popular retailers, Lululemon. But if you're a big fan of Amazon.com, and Lulu's been getting bigger and bigger into e-commerce, it's where they get a fair chunk of their revenue stream. What are you concerned about?
I'm concerned about their product mix, quite frankly. I just think that they can't stay just Lululemon. They've got to do more what Starbucks did, going to a whole different sector, right? Is where you take this thing that you're so successful at and you take that brand loyalty and you expand your product line. And I don't necessarily think they've done that fast enough. They're vulnerable to the same thing that Nike's been vulnerable to with Under Armour, and that's somebody just coming into their space and basically duplicating what they've did. You've got people doing it. You've got Kate Hudson's Fabletics, which is starting to get a little bit of traction in sales. Not necessarily something for us to talk about in terms of stocks, but they've got to expand their product line. They're doing very well with their men's line, and I've looked at some of that stuff myself. But they need to expand quicker, in my opinion. They just need to get a wider product base.
So Under Armour's got a wider product spectrum than Lululemon, and that's why you prefer that one over Lulu?
I do. I think Under Armour is a great stock. Now, you've got a 78 PE on Under Armour. It's huge, right? Nike a lot lower. Under Armour's growing their revenues at 4 times of what Nike is, and that's the real comparison, right? But if you take Under Armour to Nike, then you're looking at competitors of Lulu that may spring up to Lulu. So if Lulu expands their product base and goes into some of Under Armour's space, taking some of that brand loyalty away. When you look at what Under Armour has Nike's model, and they've beaten them on it. Under Armour and Nike are in a street fight, and Under Armour has Tom Brady and Cam Newton from the NFL signed. They've got Steph Curry, a massive coup, from the NBA signed. They've got Jordan Spieth signed. They've got the major players in the major sports, and that matters for purchasing. At this point, I think when you look at Under Armour versus Nike, not versus Lulu, you're looking at Mac versus PC. I think Under Armour is Apple, and the PC is Nike.
What about the prospect for stock price appreciation? Street consensus is Under Armour will top out in the next 12 months at about $100, suggesting 21% upside. But I'm seeing it's having a heck of a time breaking above the 200-day moving average at $88. What's it going to take to do that?
Well, I think you hit it right on the head there. I think the overall market has to get back going, and retail sales have to expand. I mean, we're not seeing that. Again, the personal spending numbers told you this. And the strange part about the U.S. economy right now is you've got GDP numbers now privately, okay? Haven't seen any of this announced yet. But some of the people I'm talking to after this morning's personal spending numbers are starting to revise their GDP forecast down for the next quarter below 1%. I'm hearing 0.9. I'm hearing some 1.1s. When GDP is tracking at 2%, and you get a really weak spending number like that, where you get 0.5% revisions, that really takes GDP forecast down. So now we've got strong jobs and we've got weak spending. And what does that compress? That compresses corporate earnings, where you've got hiring taking place, but then you've got top line sales slowing, compressing profits. So if the overall market doesn't recover, Under Armour's not going to be a good buy, Lulu's not going to be a good buy, Nike's not going to be a good buy.
I see Nike's margins on a net income basis are about 2%, but it's 6% over at Under Armour. How is it they're able to squeeze more out of every dollar in revenue?
Well, I just think Nike's been better at it. Nike is a bigger profit machine than Under Armour is, but Under Armour will get better at that. I think that the head start that Nike has in terms of their cost base is huge. But having said that, again, Under Armour is beating Nike at their own game right now. Air Jordans still sell magnificently well, but more as a collector's item. Under Armour is becoming what the new generation sees. My cousin Marco, who's on our podcast, is a millennial, and all he knows is Under Armour. And I'm always looking at that kind of thing in the same way that I look at it with Apple, where the people younger than me, and there's a lot of them, you know how old I am, the people younger than me like Apple and Under Armour.
Oh, you and me both, my friend. Thank you very much for your time.
Thanks, Michael.
Old man Iaccino, co-founder and chief market strategist at Path Trading.